Quarterly earnings. Love them or hate them, they define Wall Street. Every 90 days, companies open their books, analysts react, and investors reprice trillions of dollars. But what if that cycle is about to end? Donald Trump has revived his call to scrap quarterly reports and replace them with 6-month reporting. At first, it sounds like less red tape. But here's the truth. Ending quarterlies doesn't just change reporting. It changes who gets access to information and who gets left behind. This is second-level signals from Global Notes by JP, where we go past the headlines to reveal the hidden forces shaping markets, so you can see what others miss. Quarterly reporting wasn't always the rule. When Congress passed the Securities Exchange Act of 1934, it gave the SEC power to require periodic disclosure. But for decades, most companies only filed annual or sometimes semi-annual updates. By the late 1960s, the SEC began standardizing quarterly reporting, and in the early 1970s, the Form 10-Q became mandatory. The logic was simple. More frequent disclosure reduces information asymmetry. Investors can make decisions on current data, not year-old numbers. And that transparency helped fuel confidence in U.S. markets, which became the deepest and most liquid in the world. So why change it now? Trump argues that quarterly reports make managers obsess over the next 90 days instead of the next decade. He says fewer filings would cut costs and encourage long-term investment. This isn't a new idea. In 2018, Trump raised the same question, and the SEC opened a public consultation on whether semi-annual reporting might work better. Dozens of companies, investors, and academics weighed in, and the debate remains split. On one side, there's evidence that frequent reporting pushes managers towards short-term decisions. Academic studies have found that when firms move from less frequent to quarterly reporting, investment spending falls. Not because the opportunities disappeared, but because managers trim projects to make sure they don't miss the next quarter's targets. It's a powerful critique. Are quarterlies quietly starving long-term innovation? But there's another side. Quarterly reports also level the playing field. Every investor, large or small, gets the same baseline data 4 times a year under SEC rules. If you cut that back, companies won't go silent. They'll still talk to investors. Through analyst days, through private roadshows, through conferences. But those aren't SEC regulated. They're not always public, and access often depends on who you are. That creates a hierarchy of information. Institutions hear more sooner. Retail investors wait months for the official filings. And here's why that matters. Retail investors are already disadvantaged. They don't get allocations in hot IPOs. They rarely touch secondary offerings. And private placements are off limits. If quarterly reports disappear, retail loses one of the few channels where they stand equal with Wall Street. The gap gets wider. Not just in deals, but in information itself. There's also a market structure cost. Quarterlies give investors a regular pulse on performance. Take that away, and bid-ask spreads can widen. Volatility jumps when results finally arrive, and the cost of capital can rise as investors demand a premium for less frequent disclosure. This is why many argue that U.S. markets trade at a trust premium over other regions. Transparency isn't free. Companies do bear the cost of reporting, but that cost buys confidence. So, should quarterly earnings end? If they do, the stakes aren't just about whether managers think short-term or long-term. They're about fairness. They're about whether American markets remain open and trusted or slide into a system where who you are determines what you know. You've been watching Second-Level Signals from Global Notes by JP, where we dig past the headlines to uncover the hidden forces shaping markets. If you found this useful, hit like, subscribe, and share. Thanks for watching.